Hello and welcome to Good Investing with Rachel Grunn.
And Andrea Slick.
Thanks you guys for tuning in for another week of Good Investing content.
Are y'all loving it? Let us know.
Yeah, let us know. Send us an email to goodgoodinvesting@gmail.com.
Yep.
At gmail.com.
Right. Yeah.
That's right. And also you can go to our website, www.goodgoodinvesting.com, to find out more about our upcoming events. Check us out on YouTube if you're listening to this audio version, or vice versa if you're on YouTube. Today we have a really exciting guest that I'm very thrilled to have on.
I'm very excited to get to know him.
Yes.
Yeah.
So we have Zane Schartz on of Wolfe Investments. Now, Zane is the Chief Investment Officer at Wolfe, and he's a partner in over $150 million worth of commercial real estate and has a multifamily portfolio of over 1,000 units. He has been working in real estate investing for 7 years and has been accountable for over $250 million in acquisitions at Wolfe Investments. Wow. Zane is passionate about maximizing returns for investors and adding value to their portfolios through using creative methods to generate wealth. Now, he attended Liberty University where he played college hockey, and then he went on to play professionally for 3 years in North America and Europe after graduation. Zane is an active member at Watermark Community Church in Dallas, where he lives, and his biggest goal in life is to create a nonprofit organization that funds Christian missionaries around the world. Well, he doesn't do much. And you might think, oh, this guy's got to be 55 years old, but he's not. He is under 30. So hi, Zane. Thank you so much for coming on to our podcast.
Thanks for having me.
Yes.
Thanks for the great intro. And I never get comfortable when people are complimenting me. So I appreciate it. And thank you guys for having me.
Yeah, of course. I mean, you've done a lot in your short number of years. So how old are you? Do you want to share?
I'm 28, just turned 28. And yeah, I mean, I think being at where I'm at as a 28-year-old is nothing of my own doing, but you know, a lot of things have fallen into place, and I'm very grateful for the situation that I'm in.
So tell us where you're from and what you've been doing up until this point.
So I'm from Dallas, grew up there, played hockey my whole life, like Rachel kind of read off, and went to Liberty for college, and then started as a summer intern at Wolfe Investments back in 5 years ago. So that was 2017. And then me and Kenny Wolfe, the president of the company, just hit it off really well. And I came back the next summer for a second summer. And I also worked for Allied Property Management, which we also own. So I kind of learned the investment side of underwriting and analyzing, and also the operational side. So I did pro formas for Allied, and I did underwritings for Wolfe. So I kind of learned that side, and then I went off and played pro hockey for a few seasons, and had a great experience, and just kind of forgot about the rest of the world and played hockey, and came back on full time when COVID hit. So about 2.5 years ago, I came on full time, and since then it's been a really good upward trajectory for our company. And you know, Kenny has treated me very well and given me a lot of autonomy to kind of run things within Wolfe, and very fortunate. You know, God opened a lot of doors for me, and I just kind of said, okay, let's go. So that's kind of been a lot of my life, of just kind of following where I'm led. So
let's talk about those open doors. How does someone going to school, right, playing hockey, decide that they want to do an internship with a multifamily syndicator? I just feel like that's so off the radar of any 20-something or 19-year-old's mind. Like, what kind of trajectory were you on at school, and then how did you find out about this kind of internship program?
So I knew I wanted to be in real estate, and then after my freshman year of college, I did an internship at Watermark Community Real Estate in Dallas, and they're a medical office developer. So I worked there, and after that summer, I was kind of like, I don't know if I want to do that. So the next summer, I was looking for an internship, and my dad actually just posted something on Facebook and said, Zane's looking for an internship in real estate. Does anybody know any connections where he could get involved? And my dad's friend, Greg Grebe, was an investor at Wolfe, and he reached out to Kenny. Kenny reached out to me, and here we are, 5.5, 6 years later. So crazy.
Proximity is power.
Oh,
Exactly.
I like that. I love that.
Yeah.
That's so good. And Facebook is like this insane connector for
Right?
everything. That's amazing.
Good for you and good for your dad putting it out there.
Yeah.
Like you just never know when you pose a question who's listening and what kind of connections you're gonna make. That's awesome.
Yep.
Yeah. And
Don't
like me
ask
and Kenny
overseas.
just got along really well. My first internship, and I think we have the same kind of thought process in investing. And yeah, I mean, I kind of knew after my first internship that I would always land at Wolfe Investments, but I don't know if Kenny knew. I think the timing was just perfect. When COVID hit and we were growing at a good rate, and I kind of saw an opening, and Kenny needed somebody, and like I said, I think that was not by chance.
So when you first started at Wolfe with your internship, kind of what was your role, I guess, at the company? What was your biggest strength?
So when I was an intern, I was doing just the multifamily underwriting. So basically, all of the deal flow that was coming into Kenny, he would give to me, and I would kind of do the first pass and see if it hit our criteria for the returns that we were projecting for investors. So that first summer, I probably underwrote a few hundred deals over 2 months, and that school year after, I also just kept doing deals, just mastering my craft pretty much. And I always say in college, you're getting an internships. I was getting paid to learn, and I'm still getting paid to learn. I'm learning every day. But I think my first internship was all underwriting, analyzing multifamily deals, learning where we can add value, how to add value. Every single asset you can create value on. It's just where can you find the value and where can you find the best opportunities for the lowest cost to create the value.
So what kind of value adds are you doing, or which ones did you find the most value and impact on?
So thankfully, Kenny had a pretty good model for me to kind of step in. We had but we had the basic value add of, upgrading the kitchens, appliances, fixtures, doing some exterior renovations. We used to budget. It's funny because my first internship, we would budget about $4,000 to $5,000 a door. Rehab was kind of our standard, and now 5 years later, that is not possible. It's not getting anything done. It's $8,000 to $10,000, so it's almost doubled. And it's funny because our cap rates. I remember my first summer, the cap rates we were buying deals at were like 7.5 caps, and we were like, these cap rates are so low. And now we're buying
so
deals
quickly for our listeners, cap rates are kind of in opposing to in opposition to the value. So a high cap rate means a lower value for the property, and a low cap rate means a higher value for the property. So having a high cap rate like 7, which right now in Dallas I think it's around the 4%, maybe even lower. Around 7 was incredible.
Yeah,
incredible buying power. So continue.
Right. Yeah. So the cap rate is just valuing properties, and they used to be a lot easier to buy, and now there's a lot more competition coming from California and China money. It's a lot harder, but I like competition. I played hockey my whole life, so I'm all about it.
Why do you think people want to buy in Texas so much? I mean, we know, but maybe our listeners don't.
I think people like Texas because it's a landlord friendly state. What does
that mean?
So in Texas, there's no rent control. We have the ability to push rents whenever we want and however much we want, which is great for us to add value to properties. So the value of the property, like I said, is based off of the cap rate, and the cap rate is based off the net operating income. Net operating income is revenue minus expenses. So the more you can increase that revenue, the higher the NOI is, and the higher the NOI is, the higher the value of the property is. So when we buy a property, let's just say a standard value add play, we're going in and the NOI today is $100K. We're trying to get that NOI up to $150K because that's how you value the property. So,
and that doesn't mean that the property's worth $50,000 more, right? Because the formula that you do, if you add $50,000 of income, it could translate to a lot in value, not necessarily in direct kind of correlation to the amount of income that you generate.
Correct. So increased NOI, you would divide it by the cap rate. So you get the cap rate as NOI divided by the purchase price, or you get the that's the easiest way to do it. I could, if I had a dry erase board, I can kind of walk you guys through a lot of things.
Yeah,
But,
that's okay.
I'm not going to nerd out on numbers, but I love numbers. But yeah, I mean, increased NOI, even if you increase NOI by 20K, it increases the value of the property by so much. And then you can do a lot of plays on the back end to kind of unlock that that value that you've added, either cash out refis, you can sell it. Those are kind of the two biggest methods that we've gone about it. But, that's what I like about real estate and what we do is there's a lot of ways to be creative and creating wealth. And there's no perfect way to do it, but there's a lot of right ways to do it. So it's cool.
Yeah. And have you been able to passively invest in any of the deals that you underwrote?
Yes. So I passively invest in every deal that I underwrite. And I'm also... Go ahead.
Oh, good. And how did you do that when you just started, by the way?
So I'm fortunate enough to have not had any debt coming out of college. And, I made a little money playing hockey. And, it's not how much you put in, it's just putting money in and kind of eating your own cooking, pretty much is what I say. If I'm not going to invest in deals that I underwrite, then do I really believe in it? So I'm not here to just tell investors that this deal is good. I'm here to tell investors that this is the deal that I would invest in, and I do it myself. So every deal that I find, I invest in because I believe it's a good deal. Otherwise, I wouldn't be pitching it to our investors.
Yeah, we feel the same way too.
Yeah. And how do you define what's a good deal versus a bad deal?
One that makes money versus one that doesn't.
That's it. All right, we're going to stop the podcast now.
All right, that's it. See you guys.
Yeah, mic drop.
So I'd say every deal is different. We buy things from A class to D class, and obviously we look for value to be added on every asset. And an A class asset is going to have less value from a structural standpoint than a D class asset. But an A class asset may be needs operational improvements, and a C class might need operational and structural. So there's just finding the value that can be added and maximizing that as best we can. So for our investments at Wolfe Investments, we aim for 100% return in 5 years or less. And I believe that our average over the past 10 years has been 100% return in 32 months on every single acquisition that we have had. So we've beaten that, and we've doubled investors' money on average in 32 months. So we're pretty proud about that. I can't take credit for all that. I can take credit for the ones that I've done.
That's awesome.
Kenny's done a great job, and he's taught me a lot, and he's definitely a mentor that I'm very grateful for.
So do you guys only invest in Texas, or do you invest in other markets also?
So we do not only invest in Texas. We invest in Texas, Ohio. Currently, we're in Texas, Ohio, Oklahoma, Atlanta, and that's just for multifamily. And then on the commercial side, we own some single tenant net lease deals. They're all double net and triple net leases, meaning the tenant pays for taxes and insurance and roof and structure. And those are all over the country. There's no limitations on those.
Yeah, so let's kind of dig into kind of what assets that you're invested in, Wolfe is invested in, which one is your favorite, for what reason? And then, of course, I know the answer, but it's super interesting for our listeners as to why with triple net you can invest in states like maybe California and New York where you wouldn't touch in the multifamily space. Yeah.
So the first question, I'll give you the brief rundown of what we're doing at Wolfe. We have 3 primary branches. The first one was kind of our bread and butter that got us to where we're at, and that's just existing multifamily. And we do, like I said, everything from A class. We're buying an A class in downtown Dallas for $250K a door, or we do D class where we're buying, last year we bought a D class in Wichita Falls for, I want to say, $40K a door, and then we're putting $40K a door into it. So we buy everything in between because we want our investors to have the options. And then we buy existing office buildings, and we do office conversions from office to multifamily, and those are in downtown core markets. So those are more development plays. And in that, we also do ground up developments. So we have our existing multifamily, our development / conversion, and then my favorite, the commercial single tenant net lease arm that we do. And in that we buy net lease properties, Walgreens, CVS, Dollar General, Dollar Tree, Advanced Auto Parts, kind of those essential businesses that are necessary for, small towns and necessary in highly populated areas. And I'll talk on that a little bit more because that's my favorite. And that was kind of also your next question too, is like why we have the freedom to purchase those kind of anywhere in the country. We can buy those because on every single asset that we buy, the tenant is responsible to reimburse us for taxes and insurance. So it doesn't matter how much the taxes are, we're getting reimbursed for it. Also, we don't need to worry about rent control because our leases are locked in for however long the lease is. So if it's a 10-year lease with Walgreens through 2032, there's not going to be any rent control on that from Walgreens. We are guaranteed that money. So right now that portfolio, that branch has about 35 or 40 assets in it. And, we're 100% occupied. We've never missed a month's rent. They pay like clockwork. These are all publicly traded companies, investment grade tenants that guarantee the leases for the duration of the lease. And, Dollar General, for example, is a $50 billion company. Family Dollar is a $25 billion company. Advanced Auto Parts is a $12 billion company. And these are all the companies, these are our tenants that are backing the leases. So we don't think they're going to miss rent, and they haven't yet. So we're really happy with how that's going.
So when they sign those 10-year leases, does that just mean they're committed, or does that also mean that you have the same payment for the 10 years?
So that means that, yes, to both. They're committed for the duration of the lease, so they would be locked in for that time. And depending on the lease, they would also pay that same rent amount from today through 2032 in the example of a 10-year lease. But some leases have built-in increases to within the 10-year lease to keep up with inflation. But most of our deals are kind of in the 4 to 7 year lease term, and all of the deals that we acquire have rental increases at the end of their current leases. There's...
And
Go ahead.
And do you hold it for the whole time, or do you have some kind of resale strategy that you want to sell before it reaches the full 10 years?
So far on our current portfolio of 40 stores, we haven't sold any. What we've done is when the leases have renewed, we've done cash out refinances. So at that point, when the leases renew, the value of the property is its highest because the real value in these properties is the lease and NOI cap rate. When the NOI goes up and the cap rate is hopefully lower than when you acquire the property, then the value of the property goes up and you can unlock that value that has been created through a longer lease and a higher rent. So, we've done other strategies to increase our returns to investors. We've done blend and extend deals where we reach out to the tenant prior to the extension. We get an early lease extension, which increases value in the property. We've been working with different lenders and being really competitive on our lending that we get. So basically, we've created a environment where lenders are fighting over us as borrowers, which is kind of fun. And they give us the best terms out there because we are good borrowers, and we've proven over our 40 different single tenant net lease assets that we're good borrowers. So it's a good space to be in, and it's very consistent, stable, just a great asset class to be in.
What's the biggest difference between multifamily and the triple net leases or the single tenant leases?
So multifamily, we have more control over NOI. So let's say we buy an apartment complex in Texas. Day one, we can increase rent by 10%. It's possible to do that. If we buy a Walgreens in Texas, we can't go in day one and say, hey, Walgreens, we're jacking up your rent by 10%. So there's a little less control, but there's also stability in not having control and a locked in lease term. So, I never tell investors to just load up one and not the other. I always say diversify over different because they're all going to have different returns in different ways. And every asset in every investment that we have, we try to kind of have different things for whatever you want.
That's great.
Yeah.
So kind of establishing, what you do at Wolfe and your passions as an investor and an operator, there surely has been some hurdles that you've had to overcome in your path. What do you think is perhaps the biggest limiting belief that you had to overcome?
Great question. I think it's not as hard to go bigger as I thought it was. There's a lot of money in the world, and there's a lot of people who want their money working for them. And once you can prove that you can succeed on a small scale, I think you can implement that same strategy on a large scale. So I'd say if you would have asked me 5 years ago that, Wolfe Investments would have $600 million in assets under management, I think if you asked me or Kenny, we'd be like, we'll see. But, in the past couple of years, we've just been growing so fast. And I think it's because we've pushed the limits. And so I think we kind of put a self limitation on ourselves, or at least I did. I don't know if Kenny did, but just kind of going bigger.
Yeah, I really like that, and it's so true for commercial real estate, multifamily, triple net. The pie is so big. There's so many different slices to share. Whereas in single family, JVs really aren't a thing. Joint ventures really aren't a thing because there's not much pie to share. So you kind of got to take these on your own. You're doing most of the work. You're vouching for the loan based on your income or your tax return. You're getting credit hits all the time. I mean, when you go big and you break into like the commercial real estate space, whether it's residential or truly commercial, you're able to leverage other people's strengths. You're able to leverage another person's balance sheet to secure that loan. You have lenders competing for your loan, like you said, because even lenders, we talked about this in our inflation episode, even lenders know that commercial real estate is such an inflation hedge that that's where they want to put their money to. So you're finding better interest rates and better terms in the commercial space also, as opposed to residential. So for all these reasons, it is such a fantastic way to scale your investing portfolio, whether you're passive or an active participant in the syndication.
Yeah, and I love that you and Kenny are working, together to find the deals and growing. You both, I think partnership is so key when you scale. Like, me and Rach could have different podcasts and we choose to do it together and we want to grow together. And I think that's just a beautiful thing when you can find a partner that you can trust and then you can elevate. And the same thing for our passive investors. Like, we're their partner in finding the deals and we want to get them the best return. We're for them and we want to see their net worth and their wealth grow, just the same like ours.
That's our big why.
Yeah.
So Zane, what is your big why? Why do you do what you do? Why do you get up every day and pound the pavement?
I think God has blessed me with the gift of having an understanding of how to create wealth for people. And I think I'm just being a good steward of my gift. And, I have a lot of family and friends and people that I'm close to that are invested in my deals. And I've had a lot of investors reach out and just tell me that, hey, because of this investment, I'm able to sit on the beach and make money. Or, hey, because of this refinance, I was able to buy a car for somebody, for my kid, for their birthday. So it's things like that where, those little things where I'm at the office all day and, I don't really see those, but I hear about them. And creating financial freedom for our investors is something that I'm passionate about, but also just being a good steward of my gifts. And kind of being faithful where I'm at and with what I'm doing. So that's what I'm trying to do.
I love that. Is there anything else that you want to share?
I think, well, thank you for having me. I appreciate it. I think I love real estate I think it is awesome in so many ways. And I think there are so many fun and exciting and competitive ways to use real estate to help others, and just to, I love it. But real estate isn't who I am. It is what I do. And I
Yeah.
think that's key. A lot of people will take what they do and turn it into who they are. And who I am is I'm a Christian and I'm a follower of Jesus, and I just happen to do real estate. And I feel like I'm just being faithful with the gifts that I've been given. So, I hope that other people see the passion that I have in helping them, and see that it's not about me buying a bigger house, me buying a nicer car, me buying nicer clothes. I don't do any of that stuff. But it's about like just using what I've been given and helping others. So that's what I'm passionate about.
And what a motivating reason to get up every morning.
That's right.
If it was about the watches and the cars, I feel like it'd get old really fast.
It doesn't. It doesn't provide true happiness.
It doesn't provide fulfillment, and you really are like you said, you're pouring into other people's lives, maybe in a spiritual way as well, and in a financial way, and both are a massive blessing.
Because we're also Christians, and we truly believe like when you don't have to worry about the money and you can build your wealth, you can actually use the wealth for good to further God's kingdom. Like you create bigger impact in the world, and it's easier to fulfill your purpose that way too. So I love that. Zane, I didn't really know you before the podcast, and I just fell in love with you during this podcast. Like I'm married, but not in that kind of way.
Platonic.
Yeah. You were such a joy to have on. Yeah. I'm so incredibly thankful for the time you gave us. And I know that this is going to be a huge blessing to our listeners.
Definitely.
And
how can our listeners get in touch with you?
So you can send me an email. That's the best way to get a hold of me. And my email is zane@wolfe-re.com. And you can also check out our website at Wolfe, wolfe-re.com. And shoot me an email. Would love to talk to you guys about investing and kind of see how I can help, or anything.
Awesome. Thank you so much. We're also going to put his contact information in the show notes down below in case you guys maybe don't have a pen and paper on you right now. Zane, thank you so much for jumping on. We so appreciate your time. Thank you.
Thank you for having me.
Andrea, that was amazing. That was so great.
I learned so much, and I just love meeting other investors that have such a beautiful goal and a beautiful why. And it just makes me so happy to know that there's other people out there with the same alignment as us.
Yes, definitely. I think there's maybe this stigma that people with money or people who invest in real estate are just like these money hungry, like Russian oligarchs, whatever, really rich people. And just to meet other people in the same multifamily syndication space, commercial real estate space that have such a strong foundation and such a strong why is really inspiring. It's really cool.
Loved it. Love Zane. Hopefully we can have him back soon.
Yeah, definitely. Well, in the meantime, thank you guys for tuning in. We so appreciate. Feel free to like and subscribe on YouTube. Give us a follow on Spotify and Apple Podcasts. Give us a rating. If it's beneath 5 stars, don't. But seriously, you can shoot us an email with any constructive criticism or FAQs. Until then, check out our meetup group, also linked in the show notes, and you can download our ebook on our website at goodgoodinvesting.com. Well, Andrea, until next time, and remember, don't invest good.
Invest twice as good.
Bye.
Bye.
All right.